Hi and good evening, ladies and gentlemen. Thank you for tuning in to our webinar this evening. We have Mr. Colin Low and Mr. Ong Ziyang, our IFAS macro analysts, to give us an update on FSM maps in light of a tumultuous first quarter and the corresponding portfolio actions that were taken. They will also be sharing their thoughts on the outlook of the global markets. And along the way, if you have any questions for Colin and Ziyang, you can click on the Q&A button to type in your questions. So without further ado, let me welcome Mr. Colin Low to present.
Hi, good evening, guys. So let's begin with the slide number 2. So let's move on to the next slide. So if you can look at the portfolio performance, let's start off with the performance for growth portfolio. So let's begin with the 1 month period, so the period of March. So if you look at that period, the first column, you can see the aggressive to moderately conservative perform better than the benchmark. So the more aggressive portfolio generally have performed better within this time period. So during the recent rally in equity markets and the nature of our overweight position on the equity sleeve, this is one of the underlying reasons why the more aggressive portfolios perform much better within this period. So if we move on to the next column, you can see from a first quarter perspective, a 3 months perspective. So from a Q1 perspective, similarly, you can see that for aggressive and moderately aggressive have performed much better than benchmark. So for similar reasons, these are also due to a larger allocation to equities. And also, if you look conversely, if you look at a more conservative portfolio, they lag behind the performance or the more undesirable performance. So this is due to a larger allocation to the high yield segment of the fixed income. And because these are conservative portfolios, so the nature of it is that the allocation towards the fixed income segment is larger. Hence, there's a larger allocation to the high yield side. And therefore, the performance has actually came down quite a fair bit. So if you were to move on to the next page, so if you can go to the next page. So when you look at the income portfolio performance, we see similar trends. So you can find that for the first 1 month performance, the more aggressive portfolio performed better, and for similar reasons, performed better than the benchmark. So from a first quarter perspective, from a 1Q perspective, the aggressive and moderately aggressive perform much better than the benchmark. So the slight difference between the income and the growth portfolio comes from the more conservative portfolio, where the more conservative portfolio for the income side perform slightly better, just slightly better than the growth portfolio. So moving on to the next page. So proceeding to the fund performance, we start off with looking at the developed markets, the DM equity fund performance. So there are 2 things I would like to highlight here. The first thing I would like to highlight is our US large cap fund choice. So we swapped this fund choice a couple of months ago from the multi-cap towards a large cap, as this has paid off quite significantly across the past few months. So if you look across the board, comparing the large cap versus the S&P 500 index itself, the large cap has generally performed much better. And we find that over this past 1 to 1.5 months of sell-off, this large cap has more resiliency versus the small cap and also versus the multi-cap. So this is one reason why we really prefer the large cap and see us holding it for a good period of time moving forward. So the next thing I also wanted to highlight is the Nikko AM Japan Dividend Equity Fund. So if you look at that, the performance numbers for that is quite it is better than the benchmark. So the thing I like about this fund and why it has performed better is because the fund manager for this particular fund, they select their securities based on cash flow as well as balance sheet. So they select securities based on stronger cash flow, healthier balance sheet, as well as the ability to make dividend payments. So if you look at all 3 factors combined together, you can see that these are actually quite beneficial for those securities moving into a recessionary environment where cash flow as well as balance sheet comes into play and comes in and is more significant. So we do believe that this fund choice will help us outperform its relative benchmark and moving forward in this kind of environment. So moving on to the next slide. So when we look at the EM fund performance, so most fund choices perform similar to the benchmark. But for the case of the EMEA fund, so which is you can find that the Fidelity EMEA fund, there is a larger deviation from the benchmark, and for this fund's case is because of its natural tendency to perform, because of its pro-cyclicality of the fund choice. It has a natural tendency of outperforming in good times and underperforming in bad times. So if we were to break down and look at the exposure of this fund, you'll find that the fund, compared to its benchmark, has a larger allocation towards the more cyclical and the more cyclical side of the sector exposure. For example, consumer discretionary is one large deviation from its benchmark. So I would like to point out that this fund is, if moving forward, we'll be seeing in a more recessionary environment, this fund might continue to underperform the benchmark. Whereas most of the other fund choices are still somewhere around the benchmark area, and we are still, it hasn't triggered any red flags yet. So moving on to the next part. So looking at our tactical allocation. So our tactical allocation, two of it has actually paid out quite reasonably over the past year. So they are the semicon ETF as well as the tech ETF. So when we look across on different time period, we can find that in most time periods, this two ETF has performed better than the benchmark. So this is whereas our third tactical allocation towards the Hong Kong bond, it hasn't been performing quite on par with the benchmark because of its because of the financial sector in China as well as Hong Kong is not quite performing quite favorably because of certain macro headwinds in those areas. So let's move on to the next slide. So looking at the fixed income funds, so it's quite noticeable that for the high yield segment as well as the global bond segment, our fund choice has underperformed the benchmark. So for the high yield segments, and that is because most of our high yield funds have more exposure to the corporate side. So as you guys know, instead of having exposure, as compared to having exposure to the sovereign side, so the exposure to the corporate side has dragged the performance down a bit, because over the past 1.5 months, the corporate high yield has taken quite a beating, and because of the larger perceived risk in this segment, therefore there's a lot of a sell-off in this particular area of the fixed income segment. So moving on to the next slide. So here are some of our portfolio actions we have taken in the first quarter. So my partner Ziyang will run through in more detail as to the reasoning and why we undertake these changes, but I will just roughly go through why we do it right now. So firstly, we did increase our equity overweight by 2.5%. So we see that the earnings yield spread has actually widened to +1 standard deviation, and equity markets have indeed turned cheaper, whereas bonds market has become more expensive. So so we see a push and pull factors together on both sides. So the second change we made in March or so was to downgrade Japan to neutral, as we find there's actually a rising macro risk towards Japan in the near term, whereas in the longer term we see structural headwinds. So this altogether, this made Japan more vulnerable to the COVID-19's economic drag. We'll see it in economic numbers soon to come, and therefore we decided to shift at 2.5% allocation towards Asia ex Japan. And lastly, the most recent change we made in April was to include digital economy as part of the equity neutral allocation. So we did initiate a neutral position for this, and it was only for 10% allocation based on the proportionate size of the digital economy. So our fund choice is the All Shares Global Internet Giants ETF. So once again, like I mentioned just now, Ziyang will run through more in details regarding the portfolio actions taken this quarter. So moving on to the next slide. So right now, our color allocation, as a result of the latest change, is that we are maintaining equities over fixed income overweight by 7.5%, so by 7.5% across conservative to moderately aggressive portfolios. So the individual breakdowns can be seen on the screen right there. So moving on to the next slide. So here are our portfolio positioning currently. So for the fixed income portion, remain overweight three different segments: the Singapore-centric bonds and the EM bonds, as well as the Asian high yield. And we remain underweight the global bonds as well as the US slash global high yield bonds. And we remain neutral on the Asian IG bonds as well. So for the equity portion itself, we still remain overweight Asia, Japan, and China for the reasons I will go through in a short bit. And however, we have turned neutral for Japan, and we remain neutral on Latin America, EMEA, as well as the latest digital economy edition. And our underweight remains as for US and as well as for Europe. So next slide, please. So right now, here is our product allocation across for the income portfolio. So I would just like to highlight and bring your attention to the red dot right down below, the digital economy. So for digital economy, like I said, our product choice is the OGIG ETF. So the allocation, the weightage of the distribution is as seen across the screen. So that is the addition for both income as well as the next slide, the portfolio, growth portfolio. So next slide, please. Yep. Next slide. So right now, let us take a look at the global market performance for this quarter. So if you can look at the performance in general, you can find certain trends. So let's start off with the equity sleeve right now. So for the equity sleeve, you can see that Asia has a better performance in general. So we take a look at China as well as Asia, Japan, and even Japan itself. They have generally performed much better than the rest of the markets or the rest of the regions. So the Asia's performance followed by the DM developed markets performance. So you can see that the S&P 500 for the US, as well as Europe and Japan, they follow behind the Asia's performance. And lastly, the worst performance for this quarter goes to the Latin America as well as the EMEA. So those two regions face significant headwinds over the past 1.5 months, and that is largely due to its exposure to not only commodities but also being exposed to the COVID-19 pandemic as well. So they are being hit from the left and right. So what you see is that the performance for the first quarter, especially for Latin America, has come down by almost 45%. So if you were to look at the global bonds segment, we can find that for the fixed income side, the high yield performance are actually much more worse than the safer regions such as the IG segment. So the high yield, like I said, high yield has taken a beating over the past quarter. So this part I will elaborate more in the coming slides. Whereas the IG segments have seen much more government support and much more buying, and therefore there's a lot of inflow back to the IG segment. So let us move to the next slide. So before I begin talking about my market views, I would just like to do a quick brief on the COVID situation appearing worldwide. So you can see from the chart on the top left-hand side, we see the epidemic development phases in the different major territories. We can find that China is right now ahead of the curve. That is followed by Japan, South Korea, and from all the way to the left side of the chart, you can see most of the European nation as well as US being located around there. So that shows you how early exposure from some of the Asian markets, as well as the ability to control it within a certain amount of time frame, actually helps in bringing the COVID situation down and containing the situation for those Asian markets. So like I said, this COVID issue has become quite a pain in the butt for most of the Asian equities. So we've seen a sharp decline in asset prices, and some markets, in fact, have priced in much of this negative. So if you can look at, like I said, you can look at Latin America, even EMEA, they have come down by 42%, over 30%. So a large part of that has part of the negatives are actually factored in for some of them. Whereas for some of the other markets, we still see a possibility for the markets to go even lower. So overall, when we look at the equity markets, we believe that equity markets will price in COVID developments on the go and rapidly, and therefore we see more volatile move going ahead. So this will determine the market movement, like I said, market movement going ahead. And overall, it is possible for the global equity markets to recover before we see economic growth recovering. So, like I said, equity markets tend to front run the economic growth for the various regions. So sometimes it can be 1 quarter, sometimes it can be 2 quarters. So on average, across history, we see this lead time of 1 to 2 quarters of equity markets recovering before economic growth. But there's a caveat here that I would like to add is that economic growth right now is still, the damage of it is still uncertain because of the fluidity of the COVID situation. Therefore, with a lack of a clear path or clear trajectory of where economic growth will be in 2 to 3 quarters down the road, it is hard to assess the impact, and therefore there's still, in terms of the economic headwind, there's still quite a fair bit that we believe is still yet to manifest itself. So, but overall, if you look at the different regions, separate the different regions, we find that after the COVID situation stabilized in China equity market started to recover faster and become way less volatile. So this is a trend that we definitely see happening to other equity markets around the region. So next slide, please. Just talking about China, I would just like to point out that what we believe in as a house. So as a house, we do believe that China will lead economic recovery this year. So heading into the second quarter, the COVID crisis in China, we believe could have passed its worst. So for China's case, it is currently in its late stage of its pandemic cycle. So with that said, we see that the virus itself, the situation is much better contained in China, and we see business activities are quickly returning to normalcy. So the chart on the top shows that most provinces are near fully resumed operations, so ranging between 100% to 85% across the different provinces. So returning to normalcy means that your economic activities will start to move, start to run, and therefore economic growth can start to rebound. And overall, China is able to manage to do so because of its draconian measures, and it takes roughly around 2 to 3 months' time. So if you extrapolate that to some of the other markets, we can see that we can make a simple assumption that some regions, such as Italy or even the case of New York, we will see some stabilization in the next 1 month or so. So, but overall, in China's case, I would like to point out that while economic activities has resumed, on the other side of stuff, policymakers are still remains rather supportive via a series of accommodative monetary as well as fiscal policies. So those add up together with stringent health measures really boost its attractiveness as an economy and as a market as a whole. And we do believe that there will be a sharp rebound in domestic consumption, which is, for China's case, the most important growth driver. And we should see this after the period of quarantine, which is right around soon. So this pickup could be happening soon and driving the economic, the momentum, swinging it back to more positive side of stuff. So moving on to the next slide. So in a broader view, we find that equity markets has had its worst performance in the past 10 years. So on a quarter-to-quarter basis, the first quarter marks the worst quarterly performance in the past 10 years. There has been steep sell-off across risk assets, so equity markets, as shown over here by this chart, as well as high-yield bonds. So all the different major equity regions under our coverage have actually posted losses. But however, like I mentioned, China and Asia fared relatively better given an earlier exposure and containment of the pandemic. And we do believe that they might see some more respite with the current relief rally, so some respite in the equity markets. But we are aware that further bottom could be a possibility, and therefore a valuation approach is even more important, and looking at what markets remains cheaper than the others, since there's a lot of markets that are cheap at the current juncture. So next slide, please. So looking ahead, what we see in the equity markets is that across the board, like I said, valuation has fallen drastically. So even after factoring a deterioration in earnings, so right now the estimated earnings across different markets hasn't been revised down. So we took the initiative to revise down for most of our key markets, making critical assumptions. So we find that even after factoring in this deterioration in earnings, valuation has fallen quite drastically for most of the markets. So for those markets are Asia, as well as Japan, as well as China, both the A and H share. So we do believe that we should retain overweight position in these markets right now because it's still cheap on a forward-looking basis, and the lower valuation as well helps us to limit the downside risk in this environment while enhancing the upside when valuation re-rates itself. So conversely, we remain underweight, but we remain underweight US and Europe, but we still look to position for maybe a change because we believe that after the potential COVID related risks in those two markets, and valuation has actually came down from extreme levels despite being currently mildly overpriced. So the case is more relevant for Europe. So in this sense, it warrants a relook at certain at the valuation level as well as on earnings growth level for these markets in the next few years. So next slide. Moving on to the fixed income segment, I will just touch on the IG first before moving on to the high yield. So for the IG's case, we see rising risk as well as outflow pushing the IG segments higher. So let me first talk about the 10-year Treasury yield first. So the 10-year Treasury has actually, for the past 1 to 1.5 months, it's seen a lot of action. So it's seen selling of Treasury by foreign central bank. It's seen the Fed's buying that on buying the IG segment, and it's seen a lot of actions really over the past 1 to 1.5 months. But overall, if you look at the IG segment, we find that yields across the IG as well as the sovereign side spiked after March 9. So March 9 is when, aside from the COVID stuff, we see the oil price collapsing and sell-off in equity markets. So after March 9, when panic really took over the market, the yields has actually spiked. So this is an indication of a strong outflow and rising credit risk. So no doubt, stimulus and asset purchases by the different policymakers, mainly the Fed as well as the ECB, has helped reduce the perceived risk and car markets over the past 2 weeks. And we see that yields have actually fallen quite a fair bit for most of these segments. Whereas for the EM side, we see the recent extension of FX swap line as well as the liquidities to the EM markets also reduces risk and dollar funding stress. So those were some of the reasons why yields move up and then come down by a bit. So next slide. So looking ahead, we do see that the risks for the IG have actually declined, but the valuations level actually remaining around fair level. So for the IG stuff, for the IG segment as a whole, it received two vital support. So heavy fiscal stimulus as well as decision to buy corporate bonds. So decision to buy corporate bonds by the central bank, so for the Feds and the ECB. So this actually helped to reduce the risk in the IG segment. So risk actually come down, perceived risk has actually come down. It also restored the demand for the high quality corporate bonds. We've seen a spike in issuance in the US IG for the month of March, so from both the financial and non-financial side. And we also see greater issuance due to the support. So overall, we look at it across history, IG defaults are actually few and far between. So the slide, the picture on top actually denotes that the IG defaults are few and far between, and it's also, in terms of relationship-wise, it's non-linear to the credit spreads. So what that means is that it tends to happen when credit spreads are severely wide. So in this case, it's along the 600 to 700 bips spread. So it's still quite a low possibility of default at the current juncture with the given policy support like I mentioned above. So with that said, when we look at the valuation, it's still remaining around fair, while the yields are comparatively lower versus the high yield segment, therefore remain neutral on the Asian IG as well as underweight on the global bonds. So next slide. So for the fixed income, the high yield segment, again, we see that yields has spiked since March 9th. So, but the yields has spiked relatively more. So if you look at the yields, the spike in yields is around 600 to 750 basis point from March 9th to March 23. So March 23 is the day when Feds announced they're going to have a QE infinity and a whole host of measures to curb the market. So we've seen this increase in yields. So similarly, the what has contributed an increase in yield for US as well as a large part of the EMs is that the like I said, the oil price collapsing. So because US shale producers actually account for 14% of the US high yield segment. So and moving away from yields, and we look at spread. So spread itself widens quite significantly across the high yield segment. So the US high yield spread is denoted on the bottom chart. So that is against the US 10-year Treasury, and it's widened quite a fair bit. And the spike of it, the rate of spike, if you compare against the previous 2016 as well as 2008, it is more similar to what we see in the GFC. But spread itself is not yet at the level, but it has surpassed 2016. So overall, this shows that in the US high yield as well as the EM high yield side of stuff, we see rising credit risk as well as default risk. So next slide. So if you look at the risk involved in the different high yield segments, we do find that Asian high yield has turned more appealing, because if you look at Asian high yield itself, the yield implied a default probability of more than 3 times than of the average level. So the chart on top actually shows, if you look at the yield right now is about the 3 times historical average default risk right now is 6.9%, whereas when we look at this kind of 3 times the historical average default risk, and we look at the fundamentals of the Asian high yield segment right now, we do not believe that we do believe that the higher risk the risk itself is overpriced into its spreads. So overall, we find opportunity in this segment as due to the mismatch. And the other reason why we like this segment is because of the low rate environment, and we believe that this environment should persist at least for 2020 and possibly early 2021. So with a low rate environment expected to persist, this will spur investors to hunt for yields when the COVID situation improves. So the inflow into this higher will drive a potential huge spread compression, and therefore price gain in the Asian high yield market. So overall, we do maintain an overweight in the Asian high yield, and we retain an underweight on the global US and global as well as US. The EM as well as the US high yield. But we do remain keep our eyes open to further possibilities for these other high yield segments when the risk actually starts to fall. So we do see a possible chance of further opportunity in terms of valuation when the other segments comes down. So next slide. So with that, I've come to the end of my part. So I will pass on my time to my colleague Zhi Yang to run you guys through the actions for our portfolios.
Hi guys, Zhi Yang here. I'm part of the MAPS teams as well. So this for my segment, I'm going to talk about the 3 actions that we have done since our last seminar with you guys. So these actions were made somewhere in Feb, as well as the last one, the one that we implement a neutral allocation to digital economy was done during actually just this week itself. Okay, so the first action we did was we extended an equity overweight by 2.5%. The MAPS portfolio across all portfolio except for the aggressive one, because we are already maximum on equities, is now all 7.5% overweight on equities. Next. And the reason why we, next slide. Yeah, and the reason why we did that was that amidst the sharp pullback, I mean, Colin spoke to you guys about the prices coming down because of the COVID fear. I mean, amidst the sharp pullback in global equity prices, we could not simply just sit on our hands and let this opportunity slip by. In fact, what we did was we took the earnings yield of global equities and measure it against that of fixed income yield on a global scale. So if with the more than 20% sell-off in equity prices, right, that kind of excess earnings spread have surged significantly in excess of bond yield. In fact, if you look at it on the past 10 years, that spread level actually shot above 2%, 2 standard deviation above its 10 years average. So at this 2 standard deviation level, we saw it as a clear signal that equities is a lot more appealing than bonds at this point of time, especially because excess yield rarely actually persists at such high level and almost always retrace back to the more average level. So right now, that signal of it going up above 2 standard deviation was a call for us to actually increase our overweight by 2.5%. Next slide. In fact, if you compare across all markets, what we saw is that upside potential generally increased in just that past 2 months because of the sell-off. Because with the indiscriminate sell-off in equities, we are seeing potential upside a lot more attractive than they were at the start of the year. So we actually believe that this is a golden opportunity for long-term investors to accumulate more stocks in their portfolio on the cheap. And by doing that, what we are as MAPS holders is that we are looking at our investments with a long-term horizon. So by entering right now, yes, the market may further pull back, but with the longer term horizon, we know that this COVID situation will improve. And by essentially entering into equities right now when prices are cheap, what we are trying to do is to reduce the average unit prices of our investment portfolio as a whole. Next slide. So the second action we did was we actually downgraded Japan to neutral. Next slide. Heading into 2020, Japan economic growth was actually pretty weak already. Its Q4, its GDP was already stagnating, and in fact, it contracted 1.6% year on year, which is the biggest contraction since 2014. In fact, it's also bigger than expected of 1.0% year on year. And much of the weakness was actually stemmed to the domestic consumption weakness. But looking ahead, the growth outlook is actually pretty much more grim. In fact, we think that a recession is now inevitable for Japan economy, especially. The COVID virus actually mounted additional shock to its already weakened economy. So not only is manufacturing and exports going to see a major hit because its major trading partner like Europe, US, and China. China right now things are improving, but for Europe and US, they are still pretty much struggling with their COVID situation, and all its major trading partner having to clamp down on the virus would mean that supply chain disruption will be more or less a thing for this 1 or 2, at least for the first half of this year. And the service sector is also paralyzed by very strict quarantine measures, which at the start, Japan economy, if the Japan policymaker, if you have been keeping track, they wasn't that strict with their quarantine measures. They're still pretty much okay with people walking around without their mask on. But what has happened to them was that that kind of a lax policy actually kind of beat them in the ass, and caused them quite a bit of pain. And what the government did was they did 180-degree in terms of policy to become very strict with their quarantine measures, and of course that will definitely be necessary to curb the spread of the virus across the country, but at the heavy cost of its economic growth. So what we are expecting is that travel, hospitality, retail sectors are all going to take a hit with the decline in tourist traffic, especially with the fact that Japan is quite one of the top few tourist destinations. Next slide. Yeah, and one big thing is that the delay of the 2020 Tokyo Olympics is actually quite a bad thing for Japan. So heading into this year, one of our biggest positive catalyst for having overweight position in Japan was that this 2020 Tokyo Olympics will be able to sort of a positive catalyst to boost back its growth and spending as a major booster. But with this being delayed, this positive catalyst is now, of course, no more already for this year. And the deterioration in its domestic consumption continues because of the hike in its consumption tax and etc. And a lot of idiosyncratic factor within the Japan economy itself. And of course, the government has implemented quite a big stimulus package to help boost the domestic consumption. But what we see is that it's a bit too late for it right now, a bit too little too late actually. So since its equity market moved pretty much in tandem for the last 20 years to its economic growth, we think that the weakness in its economy, which is more or less a certainty right now for at least this entire year, or even extending all the way into 2021, is that this weakness in its economy will extend to its equity market. So while we hold quite a favorable view in terms of valuation, and in fact, the quality of the Japan companies are actually pretty good. In fact, they are the major big players still hold pretty much a lot of cash, which they can deal. They can generate returns to investors by distributing them as dividends. What we are seeing is that we should be more prudent with this particular segment. So we reduce our overweight position. We did not underweight it. We just move it to neutral, and we shifted that extra 2.5 overweight position to Asia ex-Japan equity, considering the fact that China as well as Asia seems to be one of the first few economies to be out of this COVID mess. Next slide. So the most recent action we did was we actually on our strategic allocation, we implemented a neutral allocation to digital economy. And the reason why we did this, that it's not only just on the short term, but also on the long term circular basis. Digital economy is something that we see for the next at least foreseeable 5 to 10 years will be something that will become more and more mainstream. In fact, and that transition towards is more of a long-term play, but in the short term, because of this COVID situation, it's actually accelerating that shift towards digital consumption of a lot of services such as e-commerce, services, travel, and digital gaming and digital content. In fact, if just ask yourself, how much have you actually this period especially been been purchasing things online? So a lot of goods like and I'm pretty sure a lot of the ladies out there, you guys use Taobao to purchase some of your fashion stuff as well as apparel. And in fact, even electronic and media can also be purchased online, maybe via Lazada. And I mean, the most recent, because of the work from home, I myself bought a new screen through Lazada. That's a new monitor via Lazada. So, and as well as e-services, such as GrabFood, and a lot of this, and this phenomenon is not just a Singapore trend, but it's all over the world. In China, such people are actually consuming more online compared to brick and mortar, and in the US especially as well. Next slide. And not only that, not just normal consumption, but say for example, the way you pay for your goods through fintech, like digital payment, personal financing, as well as even insurance can also be purchased online already. And what essentially will happen whenever so much people go online to do their day-to-day grocery shopping or purchase for their electronic products is that this type of electronic sellers, as well as these platform providers, they'll be able to earn a lot of money through digital advertising, and they'll be able to monetize the user traffic. So you think of companies like Facebook and Google. Yes, they don't charge you, but what it is that you are actually the product that they are selling. And not only that, I mean, right now, especially with the with everyone doing a work from home teleconferencing, is that cloud service provider will be able to benefit from the increase in internet traffic, and as well as I think on a smaller end for the SMEs, which are going to face the biggest pain right now when the economy, everyone is staying at home and not spending a lot of money, like say for example the retail stores as well. A lot of the small companies are going to see quite a bit of pain. So what they will do is that instead of investing into infrastructure, and they will try to move a lot of this into services, paid subscription services, like say for example their point of sale service, and the way they try to get orders from their clients. It will probably be an online, probably an online thing instead of an offline face-to-face thing moving forward. So we are seeing a very huge paradigm shift in the way people are reacting. Businesses are interacting with their clients, and people to interact on a daily basis through the digital medium instead of retail, or instead of the traditional physical medium. Next slide. So in fact, what we do is we take the market size of all the companies that is listed right now in the market, and we compare it to the GDP of the world. What we see is that fintech, e-commerce, e-travel, digital advertising, cloud service, so on and so forth, if you were to combine together collectively, they actually account for close to 10% of the global economy. In fact, the digital economy right now, I think back about 5 to 10 years ago, it's only probably about 1 to 2%, and right now it's fast accelerating to 10%, and we are by no means is this number going to stop here. In fact, it's probably going to accelerate all the way to 2030. In fact, it's going to be an exponential explosion in terms of the usage of digital media in the years ahead. So with that in mind, what we did was since our MAPS investments are mostly for long-term investing, so we decided to look ahead and allocate within the equity sleeve itself 10% of its weightage towards this global economy companies that is going to benefit a lot from this circular trend. Next slide. So then, so what we did was we slot in this 10%, and we scale down to the allocation of the equity allocation to each geographical region, scale down them proportionately. Say for example, the US, our neutral weight was about 24%. By that, if we take a 10% haircut, it becomes 21.5%. And we implement this across the board to make way for this digital economy sleeve. Next slide. And realistically, how we implement it together with our overweight, underweight overlay is that right now, what you're seeing, the current weight is whatever we have within the equity sleeve across the portfolio. So right now, US within each portfolio is about 16.6% in terms of equity weightage, and digital economy is 10%. In fact, if you look at it, we are so positive about the digital economy being such a long-term trend that is bigger than the allocation. The size that we are allocating it to it is bigger than Latin America, EMEA, Japan. Next slide. So the companies in these key segments are, I mean, a lot of these names right here are probably something that you guys are quite familiar with. So the e-commerce, the famous e-commerce company will be Amazon, eBay, as well as the Chinese competitors like Taobao, JD.com. And on the e-service as well, I mean, you've probably seen Meituan Dianping, which is actually the biggest service provider, internet service provider in terms of like for example delivery apps, as well as e-traveling booking kind of apps within that part. These are actually the biggest company inside that segment. as well as e-travel. I'm pretty sure a lot of these companies are companies that you can resonate with, and you guys are probably a client of them in one way or another. Next slide. So, yep, for the fintech as well. So you're looking at Apple Pay, Google Pay, WeChat Pay, as well as, in fact, a lot of these big companies, right, that same few companies that provide service all across the board. So you are seeing the biggest company like Tencent, Google, Facebook, Amazon, providing also a whole entire spectrum of services from fintech, digital advertising to e-commerce to e-services are just held in the hands of these few companies. So they are able to generate a lot of profit out of these trends. So the next slide. So what we need to do was to actually look for an ETF or a fund that hosts all these top 30 companies in this key segment. So ranging from Activision Blizzard that does all the Warcraft games, Diablo games, to Facebook, Google, JD.com, ITE, Match, which is your Tinder, the company that is responsible for producing Tinder, Spotify, etc. All these are companies that not only on a macro level, we are really interested in this segment, but on a bottom-up basis, right? A lot of these companies have quite a bit of, have quite a long competitive advantage that makes us very positive about. So what our next job was to find an ETF or fund that capture all these companies within it. So we were given, we had two choices. Next slide. So we found two companies, two ETF that host this company. One is the ushered Global Internet Giant ETF. Is OGIC, listed on NYSE. The other one is a Nikko AM Global Internet ETF that is provided by, of course, the Nikko AM company. And it's listed in, one is listed in US, the ushered one is listed in US, and the Nikko AM one is listed in Hong Kong Exchange. But more notably, we actually list out in terms of characteristic. We like the ushered one more in terms, because the EUM size is a lot bigger. It's more liquid as well. If you look at its 90 days average daily volumes, about 47,800. Its expense ratio, which is the cost you pay for to the investment manager for holding such to help you manage that equities, is about only 0.48% versus the 0.88%. And it has a longer operating history than Nikko AM, although just maybe about a year and a half so. But I think the thing that really strike out to us is that it's more liquid, as well as it's cheaper in terms of management fee, which we see it as one of the key positive in investing in the ETF in the first place. Next slide. So, and also one thing to note is that there's a lot more holdings within the ushered Global Giant Internet. The Nikko AM conservatively is a bit more concentrated, but because it becomes so concentrated, is that it becomes less diversified. So while we are quite favorable about the entire internet trend, as well as on a more circular basis, and also of course the near-term basis, when they are one of the key few beneficiary of the COVID crisis right now, is that there are cases whereby certain companies may face they have their own idiosyncratic factors. So by being more diversified, by having more holdings, say for example 70 companies within it, we minimize that kind of risk that is associated to each individual company, while taking advantage of the key trends of the entire sector. So I mean, in fact, in the ushered, we are seeing one of the company is actually Zoom, which is a product that all of us are using right now. My company is paying for it. You guys are using it to listen to me. So Zoom is definitely going to be able to benefit from this COVID crisis. Next slide. right? So what we did was we implemented OGIC in fact, this week, what we did was we rebalanced the portfolio and implement the 10% allocation across all portfolio through allocation into OGIC. So what you can see is that after our whole entire rebalancing exercise is done, probably somewhere next week, when you log into your account, you will be seeing a sizable equivalent size portion of to OGIC within that in your MAPS portfolio. I think this is the last few segment of our presentation. What I'm trying to say is that our portfolio actually benefited heading into this year, this quarter. Although this quarter was one of the worst performing quarters since the great financial crisis, with no place to hide, our asset allocation actually served to lessen a bit of damage done to our portfolio. So as a result, our portfolio actually benefited from our higher exposure to Asia and China equities, as well as simultaneously less exposure to the US and European equities. So while the US and European equities, although the China and Asian equities fell quite a bit at the start of the COVID, the outbreak of the COVID virus, what it is that when China had it under control, the China equities actually start to recover. In fact, if you compare China A and Asia ex-Japan, MSCI Asia ex-Japan equities versus the MSCI World, you can see that there's actually an outperformance of Asian and China A equities, as you can see from the chart. In fact, China A equities outperformed MSCI World in the first quarter by 11.7%. So what we're trying to say is that what we are doing is that we are, by actively selecting our allocation and overweighting and underweighting based on the fundamentals as well as their outlook. What we do is that whenever such crises were to come into play, although because we are long only equities and fixed income portfolio service, is that while we are unable to escape from such a market sell down situation, what we can do is when our selective asset allocation actually help us lessen the damage done to our portfolio. And looking ahead, what we see is that China, as a result, of course, an extension to Asia, because they benefit from, of course, China being one of the key trade partner, is that we see China leading a global economic recovery. And because of the improvement in economic growth, we're going to see a market performance that is going to be better than the global equities. And China economy right now, what you can see is that it's fast returning to normalcy, and with the market inherently forward-looking, equities have, although its economy have not really escaped the pains of the COVID, and as well as a lot of the social distancing measure, is that its equities have already recovered. People see beyond 6 months and they like what they are seeing. So we expect the same situation to be applied to the US and the Europe probably in the next few weeks. So that will be one thing that will be keeping out for. In fact, I think what Colin just said was that yes, we retain our underweight into US and Europe, but with prices coming down so much and valuation being actually quite reasonable right now already, if things were to start to improve in the US and Europe, what we will be doing is that we may actually we try to lower their underweights or even move them up to an overweight position. But that will be the thing that we'll be looking at for the next few weeks. Next slide. I think one thing to stress is that as long-term investors, as MAP holders, is that our strategy have not changed. We are always looking out for long-term value. And while the decade-long bull market has suddenly shifted to a bear market, our strategy will not change, and will always be based on a value-driven methodology. And that value-driven methodology that is focusing on long-term fundamentals as well as a GDP-weighted allocation, right, has benefited us. For example, just this quarter itself, and we think we have confidence that you will outperform us in the long run. And the sharp sell-off has unveiled a lot of opportunity in both the equity as well as the fixed income market, although risks in both categories have risen as well. So you guys can trust that moving ahead, me and our Colin and our team will keep an eye lookout forward to be more prudent and be more selective in selecting the right risk assets for your portfolio for you guys to actually be able to benefit in your portfolio in the long run. In fact, I think another point that we always get the question was that is that should I exit our investment? Should I sell off our investment right now? Or should I take this opportunity where prices are low to invest more into MAPs? We think that as a long-term investor, you won't be able, as a long-only investor, you won't be able to escape the sell-off in the market that we have seen in the last 2 months. So being able to average down through probably a dollar cost average strategy, you'll be able to take advantage of trying to lower the unit prices of your portfolio. So when a market eventually recovers, we are thinking about by year end, all the markets, the global markets will have already recovered by then, and you will be able to benefit from that kind of gains in equity prices. So, with that, I'll come to the end of our segment. Thank you for taking your time to tune in today.
So thank you guys for attending and joining this very delightful MAP seminar. So we hope to see you guys real soon. And yeah.
In the meantime, please do stay safe and keep to your social distancing measures. Right. Thank you. Hope to see you guys soon.